Save 30% for taxes is the most repeated advice in the Founding Year Coach Handbook, and it's the most likely piece of that advice to be wrong by 10 points in either direction for the specific person hearing it. This unit is the centerpiece of the module. It gives you a 4-variable methodology that produces your number, not a composite person's number, and turns that percentage into the operational input for the tax reserve from Module 6.4. You've heard the rule from someone who meant well, a friend who's been coaching 3 years, a Facebook group post, a Reddit thread on R freelance, maybe a bookkeeper. The rule has the shape of competence. It's specific. It's easy to act on. It sounds like the person saying it actually knows. The problem is the rule was never built for you specifically. It was averaged across a composite self-employed taxpayer, and the composite doesn't match any single real person on any single one of the 4 variables that actually drive the answer. The 30% number was assembled for a hypothetical person at a medium federal bracket with average state tax and the SE tax bundled in. A Texas coach with no state income tax and a W-2 spouse who already filled the lower brackets is probably over-reserving by 10 points. A California coach with no deductions captured and a single filing status is probably under-reserving by 7. The heuristic is a placeholder until you compute the real number, and the real number depends on 4 variables that the rule averages away. The first variable is your federal marginal rate. Federal income tax is progressive. The rate on your last dollar is not the rate on your average dollar. The 2026 brackets are 10, 12, 22, 24, 32, 35, and 37%, with breakpoints that depend on filing status. A coach whose W-2 spouse already fills the lower brackets sees self-employment income taxed at 24% or higher from the first dollar. A single filer coach in year 1 of low income might see most of theirs in the 12% bracket. Same revenue, very different math. The second variable is your state marginal rate, and it carries the largest single swing factor. 9 states have no income tax at all. Variable 2 is 0. California's top bracket is over 13%. The state you live in by itself can change your effective rate by 8 to 13 points before any other variable touches it. Same federal income, same SE tax, same deductions, completely different total bill depending on what state line the work happened on. The third variable is your SE tax exposure, and the heuristic treats it as fixed when it isn't. For a sole prop or single member LLC, SE tax is roughly 14.1% of net income, the 15.3 rate on the 92.35 adjustment. For an S-Corp owner, SE tax only applies to the W-2 salary portion. The distribution is exempt. That single structural difference can move the effective rate by 5 or more points at the same gross income. The 30% rule pretends this variable is constant. It is the variable that moves most when entity structure changes. The fourth variable is your deductions, and every line you capture shifts at least one of the bases. Home Office reduces the Schedule C profit before SE tax computes on it. Self-employed health insurance reduces AGI but doesn't touch SE tax. Retirement contributions reduce AGI and may also restore QBI eligibility if you're near the phase-out. Mileage. Software. Once a coach captures the deductions the catalog in Unit 15.7 surfaces, 5 to 10 points typically come off the effective rate. The 30% number assumes you're capturing nothing in particular. 7 steps run the methodology end to end. Step 1. Pull your net Schedule C income, prior year actuals, or projected current year. Step 2. Subtract above-the-line deductions, half SE tax, self-employed health insurance, retirement contributions. Step 3. Subtract standard or itemized deduction. Step 4. Apply your federal marginal rate to the self-employment portion of taxable income. Step 5. Add state marginal rate on the same base. Step 6. Add SE tax from Unit 15.2 or payroll tax burden on salary if you're S Corp. Step 7. Sum. Divide by gross self-employment income. Round up slightly. That's your number. Recompute when one of the four variables actually moves. Income jumping by more than about 20,000 changes your marginal rate position. Marriage shifts the filing status brackets entirely. Moving to a different state changes variable 2 from one number to a completely different number. Electing S Corp restructures. Variable 3. A material shift in deductions, opening a solo 401k, picking up a family health plan, moves variable 4. Most coaches end up recomputing once a year in January using the prior year actuals. Jordan is a composite who shows what the methodology does to the rule. Single filer, Texas, variable 2 is 0, 85,000 net Schedule C, 20,000 into a solo 401k, 18,000 on self-employed family health insurance. The 30% rule says save 25,500. The methodology computes federal income tax around 2882, state at 0, SE tax around 12,005, total around 14,887, effective rate 17.5%. The $10,600 difference is what would have sat in a low-yield reserve account instead of going into the solo 401k where it does compounding work. Open the effective rate methodology worksheet, plug in your prior year actuals, and let the 7 steps return a percentage. That percentage is your per deposit tax reserve transfer rate. Update your bookkeeping software's transfer rule to the new number. Add a January recurring task to rerun the worksheet against the most recent prior year actuals. The methodology is the bridge between the abstract tax math and the operational rhythm that makes the April reserve actually cover what it has to cover. Variable 2 is also where most coaches get tripped between year 1 and year 2. Bracket creep happens quietly.